I break startups into four key stages, right? Because after that you become a mature business, and then it's a very different ball game. I start from ideation, and ideation then becomes formulation. So there's an idea, then there's a formulation stage, then there's an adoption stage, and then there's a scaling stage. In ideation stage, I think the two big things that matter really are the person who's building it. So I think founder is common across everywhere, but later on, it's about the founder's ability to bring other people who can run, who can scale and delegate. But in the early days, the founder conviction is very strong. So if you actually plotted everything on an X and Y axis in terms of intensity and sort of time, the founder conviction is actually very, very high in the early days, and it goes down. It never goes below a basal rate, but it can go down, and your conviction can be more on the CEO or the CBO, the CXOs of the company than the founder itself. The founder can actually peter out over a period of time. But the first up to, let's say, 0 to 100, it's really the founder, right? It's all about the founder.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Dhruv Dhanraj Bahl with us. Dhruv is the founder and managing partner at Eternal Capital, an India focused early stage fund. Dhruv was previously CBO of merchant lending at BharatPe and had previous leadership stints at Paytm and Airtel Payments Bank. In this episode, we talk about Dhruv's story and how he started investing. Dhruv shares his experience of being an LP in VC funds versus doing direct investments, the different stages of a startup's journey, how should founders approach early PMF, why he is extremely bullish on the India opportunity, his biggest learning investing in startups, and lots more. So, without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Dhruv, so good to have you on the VC10X podcast. How are you doing?
I'm good. How are you? How's it going? And
Very
thanks
well,
for
thank
having
you.
me.
Yeah, it's a pleasure having you on, and I'm doing great. Thank you. So, to start things off, can we first have your story and how you got into investing?
Great. So my name is Dhruv Dhanraj Bahl. I'm the founder and managing partner of Eternal Capital. We're an early stage fund uh, built by operators and for operators and backed by operators. But this journey is 18 years of a career coming to fulfillment. So actually, I'm born and brought up in Delhi, Prashant. Um, Grew up, and when I was about to, 20 odd years ago, about to go to university, 23 years now ago, when I was going to go to university, my options were CA, engineer, doctor. So I said, "यार, dad is a CA, तो एक में हाथ में दो तलवार नहीं रह सकती." So I'm like, I'm not doing that. So and I couldn't decide between engineer and doctor, so I decided to go for biomedical engineering. Studied biomedical engineering on scholarship in the US. Spent 4 years there, and then I realized I'm going to have to do this JEE kind of exam for the next 15 years and $1 million in debt. I was like, I'm not doing this. Came back to India and I joined Fortis Healthcare. Spent 6 years as a P&L operator. Pretty much learned everything. Learned that life is, day to day, Monday through Monday, month to month, quarter to quarter, year to year. Um, and uh, you know, what it takes to run a P&L in terms of people and profit and process, and so it was very interesting. After about 6 years, I realized, very interestingly, this is going to somewhere, um, you know, is a baptism by fire. It's very opportunistic. So I decided to sort of round off my career and go to INSEAD, got an MBA. From there, like all people in MBA did do, went and got a good job at an MBB consulting firm. So I joined Bain and Company. Um, Spent 3 years there. Started out being a generalist, then did some work in consumer. Then I saw the tech world coming up. Then I did some work in the private equity side, and some of these sort of broad exposures around consumer tech, the private equity investing side, got me to understand that India is just starting out. It's, while we think, India's been a tech hub for many years. India's pure sort of digital journey is only just starting. So that's when I decided to sort of leave consulting and join Paytm as head of business operations. Spent just under 2 years at Paytm, and like everyone else who's seen that Paytm journey, who's seen demonetization, who's seen the crazy growth story from only Alibaba coming in to suddenly, like, SoftBank and then Berkshire Hathaway, I also got bitten by the entrepreneurial bug. But that was the time when I was trying to start a family, and my wife and I were like, okay, we can't have two babies in the house, so we need to decide. And my love for early stage had sort of just blossomed by that time. So I decided, yeah, kuch karte hain, but still need to bring a paycheck into the house. That's when the first time I started doing advisory and sort of EIR roles with funds and large corporates, and started experimenting. My idea was, let's look for a good idea, or let's look for good co-founders. But in the end, I actually found my passion, which was actually working on a problem where the 0 to 1 had been solved, but the 1 to 100 was the next challenge. 1 to 10, 10 to 100. And that's when I realized about myself that I'm not great at 0 to 1, but I'm good at 1 to 100, and I'm amazing at 100, 10 to 100, right? Sort of like, that's my sweet spot, and that's where I want to be. And after 100, I get bored. So I was like, yeah, ye karte hain. So looking for that, I actually found an opportunity with a company called Roadzen, which was in the insurtech space, doing AI ML about 7 years ago, before anyone else was doing it. Got along with the founders. We raised a couple of rounds, built that company out from single digit crores to triple digit crore revenue, grew it tremendously, selling two products in one country, one product in two countries, to selling about seven products in about 18 countries of the world. Got a great experience. And somewhere in the end of 2019, a couple of my investor friends, who had, of course, had seen my journey at Paytm and Roadzen, started saying, hey, we think, you might just be very good at one of these companies that is about to break out. And want to introduce you to our friends at Sequoia, who then introduced me to Ashneer at BharatPe. And then I spent 4 years at BharatPe. The first 2 years were just grow. Then we went through some unfortunate times at the company. And then we decided to sort of, spend 2 years working with the leadership, actually part of the leadership, but also working with the new leadership to stabilize the company. Left last year to start my own fund. Now, the fund, basically, this is the first layer of the onion. The second layer of the onion is, when you go through these journeys, if you're lucky, you see equity game once. I got very lucky. So I saw a couple of equity outcomes from, uh, Paytm, and then Roadzen, and then BharatPe, and that money, I felt, was what I call risky capital. It came because I took the risk, and I felt it only made more sense to put it back into risk. Now, even public markets is risk, but I had a very specific form of risk in my head. So I have this, for many years, I've had this sort of framework in my head, which is, capital has three forms: financial, social, and intellectual. If you chase social and intellectual capital, you'll get financial. If you chase access and information, you'll get returns. But if you chase only returns, you may or may not learn something new, you may not meet someone new. So I was very clear, I wanted to go wherever the convergence of these three forms of capital was, which is either be an entrepreneur or back entrepreneurs. And so that's how I did. Since then, I've invested in about 60 startups, life till date today, in the last 5 years. I'm also an LP in about 12 funds. So I've understood what it is to be, someone else making those investments for you, and then picking your brain when you're an expert on it, or actually putting your money down and then actually helping founders build on first principles and actually having skin in the game. And that's when I enjoyed that journey so much, is where I decided to then sort of become an LP, and go from being an LP into an angel investor, from an angel investor into a GP. And that's how Eternal Capital came to be. And that's sort of been my journey.
Yeah, very interesting journey there, and many different aspects to dig into. So, first we'll pick the different parts of a startup's journey. So there is like 0 to 1, 1 to 10, 10 to 100, 100,000, and so on. What are the differences in all these different stages, and which kind of person is a fit, or what are the different approaches that suit all these different stages? How do you like to put that?
So I think the way I break out is, I think I break startups into four key stages, right? Because after that you become a mature business, and then it's a very different ball game. So the way I start from ideation, right? And ideation then becomes sort of in some ways formulation. So there's an idea, then there's a formulation stage, then there's an adoption stage, and then there's a scaling stage, right? So for me, those are the four stages, and you're rightly, it's 0 to 1, 1 to 10, in somewhere in there, right? Now, in ideation stage, I think the two big things that matter really are the person who's building it. So I think founder is common across everywhere, but later on, it's about the founder's ability to bring other people who can run, who can scale and delegate. But in the early days, the founder conviction is very strong. So if you actually plotted everything on an X and Y axis in terms of intensity and sort of time, the founder conviction is actually very, very high in the early days, and it goes down. It never goes below a basal rate, but it can go down, and your conviction can be more on the CEO or the CBO, the CXOs of the company than the founder itself. The founder can actually peter out over a period of time. But the first, I think, up to, let's say, 0 to 100, it's really the founder, right? It's all about the founder. So the first three stages, where ideation, formulation, and sort of what I feel like in some ways adoption, is where the founder is there, because there's a lot of iteration required. But in the earlier stage, it's founder bet and it's size of the market. How big a problem are you chasing? Like, I think what happens mostly, what I've seen nowadays is people will find a great solve for a very specific problem and never think about the so what. अच्छा इसको solve कर दिया तो so what, आगे क्या होगा, then what next, right? For example, if you solve, let's say, um, auto repair, let's talk about auto repair, right? If you build a garage and people can conveniently service their car, okay, so what? Can one garage do 10-kilometer radius? Can it only do 5-kilometer radius? If it's only 5-kilometer radius, how many cars are there? What is the frequency rate? Okay, then what happens when you've reached functional or operational peak, or saturation in that garage? You can't grow revenue beyond it. Are you going to build another garage close by and hope that it reaches there, or are you going to think of ways to increase revenue? Then, so you have to discover the problem size. I think sometimes thinking through that, do I have enough problems to solve from size, is very important in the ideation stage. So ideation is all about size and founder. I think if you get size and founder right, it's really those two things work. The next stage, which is formulation, is where your PMF comes into play. So the founder conviction and the size conviction has to stay. Your market should not get disrupted before your formulation is completed. In my opinion, the market should only grow, not reduce. For example, with the introduction of credit on UPI, I have a feeling that the market for, or my belief is that the market for cards and card machines is actually declining. So if anyone's is trying to come up with a new model that's designed on predicated on cards today, right, Prashant? They're really going to have a challenge, or they're going to, in my opinion, suffer when 2 years later, when they are going from the formulation and sort of the adoption stage into the scaling stage, because there'll be nothing left to scale, right? So I think that's very important about product market fit. What comes, I think, in the adoption stage is really all about economics, right? Can you continuously, अगर 100 रुपए खर्चोगे तो 102 रुपए बनाओगे? Because if you are going to be in a negative working capital environment, or you're going to be in a negative sort of economic environment, and you have to continuously burn money to make the adoption stick long enough, right? Then I feel like either you are that one in a million startup that's going to get that kind of money, right? Everyone says, अरे देखो Zepto ने कितना पैसा उठा लिया, अरे देखो जोमेटो कितने साल से फ्री कर रहा था, 12-15 साल से फ्री कर रहा था, अब सडनली देखो हाउ जोमेटो सडनली चार्जिंग ₹4 per order, ₹5 per order. But the fact that they do like nearly 80 lakh orders in a week, they are making 500,000 every week. They make like 25 million just on the back of convenience fee on every order. right? And look, they're making more, but they'll still. But if you think about the fact that there is $600 million to get here, if it was just convenience fee, it would take them so many more years to recoup all of that money, right? So my view is that economics is always important in the third stage, which is the adoption stage, right? And then when it comes to scaling, I think scaling is a function, in my opinion, a lot about processes. How well have you thought through the process? How redundant have you made it from people? Like, have you thought of things like one of the big things I talk about is customer experience. People talk about saying call center bithha denge, problem aayi to. No one thinks about incidence reduction. No one says, okay, the problem should not come in the first place. If it comes, it should be auto answered or auto solved, right? I'll give you an example of Zomato. I was chatting with someone, uh, you know when I was thinking of changing a job, and the then CEO of Zomato told me, he says, at one point in time, we used to get 220 calls per thousand orders. Today we get 7 calls per thousand orders, and this was a couple of years back, right? And he says we want to reach a point where before a problem has happened, we tell the person, hey, this problem happened. Here's your coupon. Go ahead, redeem it on this date, and it should be fine. And the next time it should happen is like we already like we've said, hey, we know it's Wednesday night. You like a pepperoni pizza. Your coupon has been applied. We've applied a special coupon on top of that. Go ahead and order. Like we should be able to influence behavior, not just correct behavior, right? So my point is they're on that journey far early in their thing, and I think processes matter when you want to scale, right? That makes a big difference. Look at Indigo as an example, the world's most valuable airline. When it was a startup, it made sure we should have a process for everything, right? Now it's the same process that allows them to run, like, 60% of the Indian market of airlines today. So I think those are the things that are important in every stage. And in my opinion, it's cumulative. It's not कि ये भूल जाओ क्योंकि अब stage change हो गई है. I think all of those things matter over a period of time. The intensity may be varying. Early days process is very low, but PMF has to be high maybe during your sort of formulation stage. Like just come up with what works, and then we'll build the processes around it. You can't have processes set in place and saying sorry, we won't change it. But once you figure out, hey, this is the product, it works at these economics, now let's just codify it so that it never changes. So for me, those are the 4 stages that matter, and so some of those are the things that are important.
Right, absolutely. Yeah, that's a very insightful answer. And just a quick nudge there, I'd request you to try not to use Hindi because a lot of our audience
Oh,
is
sorry. My
international
apologies.
as
My
well.
apologies. My apologies.
No, no worries, no worries. Uh, but great answer anyway. So now let's talk about being an LP versus directly investing into startups, because you've seen both sides of the story. So were the LP opportunities that you took because people in your network or the people you know were raising funds and you thought, okay, I have the money, I should put in some money in that fund, and that will also add credibility to their fund? You yourself have some your friends as LPs in your fund as well. Was it more about that, or did you like properly evaluate the fund? What was its focus area, and what's the edge and all those things that a fund is evaluated on? So that's one side. And how do you contrast it to making direct investments, because you were always making direct investments,
Yeah.
even previously, even angel investments as
Yeah.
well, and the dynamics are completely different being an LP versus being a direct investor. So how did you manage that, and what's the difference between the two?
Okay, so I think a lot of questions. Let me first pick up the first one. So, first, why investing in funds? So let me first say why I became an LP. Then I'll tell you how I evaluate the funds, and then I'll talk about how it differs from angel investing. So for me, the first and foremost thing that mattered was, um, I actually stumbled across becoming an LP very accidentally. Right? You work in an organization like Bain. A lot of people leave to become, associates and senior associates and principals, or partners in funds. And then they come back and they say, hey, look, I'm doing this and I think this is great. And because that trust is there with that individual, you will go ahead and evaluate that fund. So in my case, it was no different, right? So in the early days, it was more around taking bets on funds or people who other people recommended it. And then I didn't understand it till I, cleared out my B school debt, and I had a little bit of money with me, and money started accumulating. And I said, "Chalo, balanced portfolio banate." And sorry about that, but I'll try to keep it in English. But like someone said, let's make a balanced portfolio. And my idea was, Hey, what is a balanced portfolio? And one of the things was, 5% of your portfolio should always go into, you know unlisted or alternate assets. I said, okay, well, I don't know these assets. I need to evaluate good managers, so I'll invest there. But I wanted to understand the returns. So I actually sat down with someone and they showed me, look, if a good fund draws down money, it draws down money over 2 to 3 years. It usually does what is called DPI 1, which is, distributed, paid in capital. And so what proceeds have been distributed back to you, and that usually happens by the end of the fifth year. And then if a fund is an 8 or 10 year fund, then by the end of the seventh year and eighth year, you start getting some proportion of the money back when they close the scheme out. Now, if a fund is well performing in a market like India with, let's say, a 32% CAGR, you could expect, like, that's what the kind of returns or IRRs you're expecting. So I said, okay, well, if that looks like it seems like if I was to, I had modeled it out in my head. I said, okay, if I was to take a bet on one fund in year one, and then the second one in year two, and then third in year three, and everyone is evenly taking it out, by the end of year five, I would no longer be taking money out of my pocket. And the amount of money I invest, because one CR in a fund, right? One amount of money I invest in a fund, it would be like I bought a property between 4.5 odd crores of rupees over a period of time. And then you're telling me that in year eight, they'll give me some kind of return back. Let's say it's a conservative 4x return. All right. I've got 1x now and I get 3x in the future. Um, that means on a 4 crore investment of a property, I'm getting a 3 crore rental back every year from the eighth year onwards. But for that, I need to keep investing money for 8 years. And then I did that model in my head, and I'm a very risk averse guy. So I did the model in my head, and I was like, okay, if I just figure out what's the secret sauce of evaluating funds, and if this model works, I'm going to be 40 years old and never be working again in my life, because I'm going to be getting like, like more salary or more money back. And that's literally how it started, Prashant. It was literally like a wealth management or a how do I buy back my time kind of, you know, initiative. I started putting money and into funds. And the way I evaluated funds was I started looking at funds by thinking, okay, let me talk to people, social capital, go and pick people's brains. So I spoke to at least 25, 30 people I know who were LPs in those days. And this is 2015, when the number of LPs in India was very, very small. So I somehow find friend of a friend of a, brother of a friend, and like said, I want to do this. What do I do? And I just badger people with questions. And I think I found three things common whenever I ask, what do you think is different about this fund? Why is this fund performing better than the other investment? And what we found was people who played on time heterogeneity. That means fund managers who did not draw down all the money quickly within a bubble, but rather took money slowly over 3 or 4 years. Because they spread the money over a certain multiple macro cycles and multiple risk cycles, they were able to give higher than index returns. Number one. Number two, what we felt was people who had functional depth mattered. And for me, the third one was that I did not give money to any banker. So I would, if I could not look the GP in the eye, I would not invest. So if a GP didn't come and raise money from me directly, I wouldn't, because I said, look, I'm investing on you. I'm not investing on some brand that you've built, right? I'm investing on the person who's taking these calls, and I want to at least have an hour-long conversation. Um, One of my favorite teams of people who have actually backed, you know, on this principle very, very consistently has been the Speciale Invest team, a deep tech fund run by Arjun Rao and Vishesh Rajarao, right? Um, I absolutely love the way they are, right? Very, very sort of, very contrary to my Punjabi personality, right? Very, very sort of, very Bangalorean, very, very Chennai, very, very subtle, understated, very deep into expertise, what they do. And they've consistently built some of the most beautiful portfolios over the last 3 to 5 years that I've known them. And so that
Right.
formula has worked, right? Similarly, another new fund that I've taken a deep bet on is Sohail Samir, Kunal Suri, and Saurabh Vashisht, right? The two ex-founders of SimSim, and Sohail Samir was the ex-CEO at BharatPe. Again, no rush to invest. We'll only do if we really believe the deal is very good, where we can create an alpha and go really deep, and have a stellar track record coming in, right? And then there are funds like Bloom who, just from a from a I think value and a thesis perspective, I just respect the team tremendously. So there are, while I've done a lot of funds, I mean, these are the three that I just wanted to sort of name, that why that evaluation happens. So I think it's a very personal thing, but I
Right.
realize that it's a great wealth management tool. It's a great wealth management tool if you can pick a good fund.
Totally. I would agree, but I think you assumed you were saying you're taking a conservative estimate about a fund going 4x.
Yeah.
Uh, so would you say that's a conservative take in the Indian market in the VC space?
Yeah. So for me, I think I'm consistently seeing returns between anywhere net of tax, net of carry. I'm seeing returns between 6 to 11x from the kind of funds that I'm investing in.
And yeah, that's also important to take into consideration the vintage you invested in. So
Yeah,
what were the years?
my vintage. Yeah, I mean, but even some of the newer vintage funds, um, like
Hmm.
I'm proud to say that even in the height of the bubble, like a fund like Speciale, which was a new fund for me at that point in time,
Hmm.
um, they actually were very disciplined about their investing, about their valuations, and for that reason, I don't see great mortality there, or I don't see, sort of an overvaluation bubble there. They're consistently growing and doing great stuff. So I think um, maturity of the fund manager is a big thing, which matters. I think Indian vintage funds are spectacular. India's having that iceberg moment, right, where the world is only seeing like 1 or 2% of the top, and a lot is hidden, and the world is slowly discovering it. But my view is that it's only going to improve. So India is the only market globally where, because it's still very very cost sensitive, price sensitive, you're consistently seeing the yield rates of startup investments grow up. I mean, sans few small bubbles in the middle, it's a 8 year, usually it's about an 8 to 10 year journey when you look at these fund returns. And I think
Right.
that consistency, India is only on an upward trajectory, in my opinion. Right now, how do I sort of evaluate? I said the three criteria, but why did I do beyond a fund and into startups? I think after a while, you know, as an operator, and I don't think everyone should do it. I don't think it's everyone's cup of tea. But as an operator who's been in the early stage ecosystem, who's sort of building a company which is going from, like, I mean, I joined BharatPe with zero revenue, right? When I left, it was about 1500 ARR revenue. So when you go through that journey, you also know what are the trials and tribulations you go around that time, right? So that 4 year journey, you can actually connect better. So you can connect better with founders. You can connect better with the problems that they're going through. You can offer more practical solutions, and more often than not, what you actually see is, you're because you're able to identify how they're approaching or going about solving a problem, you can actually take a deeper bet. So for example, I have 4 criteria which I use when I start making investments, right? Who, what, why, and how. Who am I backing? What are they building? Why are they doing the business? Every business is to make money. So are they actually on the path of making money, and how are they going about doing it? So I don't do any pre-seed investments. I will work with the founder, help them raise around from angels, do everything. And only when they sort of reach some level of traction will I say, okay, now I'm going to put my money down, because now I know I can sort of, in some ways create an alpha for myself by either identifying the right person and the right problem or the right product, or even help you solve it in the right way going forward. So that's really for me, Prashant, the sort of criteria of why I started investing directly, right? Also, I think when you want to take deeper bets, what happens is when you give money to a fund takes bets on their own thesis. But if my thesis is like, so for example, my thesis in SaaS has always been from Bharat. So I truly believe that SaaS is not an Indian game to be played. Subscriptions are still about 5-7 years away from India. But India, because of its technological superiority, because of aggressive bandwidths that they can afford, in terms of capacity or delivery or fast iterations, India will always rule the sort of net export market of SaaS. So I think the idea is that, can we find startups which 3, 5, 7 years from today are going to be truly global net exporters of a global problem? So, right. So if someone's doing something in the insurance claim solving department, which is a global problem, or someone's doing something for sales management or sales performance management, again a global problem. Someone is doing something for, let's say, um, you know, DevOps on AI, again a global problem. So there's some of these things which, you could be sitting and creating in India, and then you sell abroad, and you can, in India it's very easy to do a, you can sell the product for free, do a freemium beta testing, give it to 100,000 users, give it to 100 companies, do it for free, solve it, and then you go outside and you don't care, because one client outside is, the AOV is maybe 7 times, 5 times, 7 times of what India gets you. So you could easily just sort of make up for lost time in one client order, right? And for me, I think that was a great thing. So everything in that has been just there, right? And saying I'm very targeted. I know these are the things that are going to do well in India, and I just want to go do that. A fund may believe in, let's say, BNPL. I may invest in them. They may do BNPL. I know it's not going to do well, but I can't influence beyond a certain point. But I personally haven't invested in any BNPL startup because I don't believe in that model. I fundamentally believe that credit, consumer credit or an NTC credit is a big people's game. It's a big balance sheet game. Just going out and distributing loans is not the game to be played. But if someone's building collection SaaS, someone is building underwriting SaaS, someone is building wealth SaaS, that's really the game. Because how do you get the next 250 million Indians into the formal lending economy, into the formal investing economy? Can only be done when the economics improve, because they are not going to be able to play the kind of large order sizes that customers of a cool startup like Cred play, right? um, they're going to be maybe 1/10 that size, and by virtue of that, the economics are going to be squeezed. So until technology is not solving all the things that they need to solve, um, you're not going to get scale. So I think, very, like, when I started becoming more thesis led, then I started saying, yeah, okay, I'm going to go down this rabbit hole, and I'm going to go down this rabbit hole, and I'm really going to put my money where my mouth is.
Absolutely. That's very interesting because I was wondering that if you're an LP into funds which are also serving the same market, more or less the same stage focus as well as you, then how do you kind of differentiate
Yeah,
and ensure that you're not competing with them and it's
yeah,
truly what you want to invest in?
true.
So that's very interesting to learn. Awesome. And you seem very bullish on the Indian opportunity, right? The massive India opportunity. How do you look at it? If you could give us a bird's eye view, would you say we are in a bubble of some sorts, or how do you look at it in general? Your perspective.
So I think bubble is a very momentary term to use. To be honest, people tend to look at bubbles and say, "Oh, now is a bubble. Then was a bubble." And my view on bubbles are created by human beings. Let me ask you a question, right? Do you think war is bad?
Sorry, what
Do you think
is
war is bad? War,
war? Yeah, of course, yes.
right? Um, then why have we fought like 15 to 20 different wars in between different nations at different times? Did people not realize World War II was bad? Look at the devastation it caused. Why did the
Hmm.
Korean War happen? Why did the US go into the Korean War? Or why did they do the Vietnam War? Right?
Hmm.
You know, if India successfully has beaten down, incursions onto its border multiple times, why have people? The reason is that whoever's leading from the front, whoever's controlling, in that case, the armed forces or the power, in this case, the balance sheet, has their own conviction that they want to invest with, right? There are points and time when those convictions tend to become compounded, right? And people will then take larger bets, thinking, "Oh, this is it. This is the time. This is where we go all in," right? Um, and somehow, you know, unfortunately, if all the players on the poker table go all in at the same time, there's only going to be one winner who will walk away. But the game is over for everyone. The game is over, and it'll take a while for everyone to bring the pot, buy in and come back, sit on the table again. And that's what I think happened in 21, 22. People just went all in, and effectively, what happened was every player on the table, everywhere in the world, went all in at the same time. And so, for about 2, 3 years, no one has, you know, neither the ability, capability, or gumption to like play again, right? They are waiting for to build their corpus back up and do their day job and come and play the poker at night. So I think bubbles is a very dangerous word to use. What I think the India opportunity in my is not a bubble. I think India is a macro opportunity, which, if looked at it in the right way, is super cool. So think about it like this: a good, the word I read on in a Goldman Sachs report was effervescent. If there is a good effervescent economy, bubbles well, somewhere between 1.2 to 1.3 times GDP from a market cap perspective. US is currently at about 2 plus times. China is now, after its crash, after the Evergrande crash, is at about 0.7, 0.8. But it was at 1.5, and so at 1.5 a market starts frothing over. India is a $4 trillion economy sitting at about $4.95 trillion worth of market cap. So we are bubbling in the right amount, and we go up and we come down, and we go up and we come down, and a lot of it might, you can argue, is built up because the F&O market is so over leveraged and the government is bringing it back and all that. There are macro plays, but for every positive macro play, there's a negative one. For every negative one, there's a positive one. But India is moving in the right direction. Now, India has to go from a $4 trillion economy to a $8 trillion economy, right, in the next X number of years. Your market cap also needs to go from 5 trillion to 10 trillion, right? Now you also have mature businesses. Let's say a good, now because we have, our participation of digital is very low in the current scheme of things. Let's say 90, 98, 99% of the market is, you know, traditional. And in that, let's say 30% of that is small and mid cap, and it's mostly um, still catching up. Let's play it's catching up, so it's growing faster. If it's growing faster, that means that the more larger, bigger, fatter companies are growing a little smaller, a little slower, and as the mid and small MSMEs are also becoming bigger, they're also slowing down. Everyone's going to the slower side. Now, India needs to keep that sort of next 5 years double economy, 20% CAGR growth rate story going. It needs to, at some point in time, have a couple of catalytic functions that just kick in and say, this is where it's going to come from. So let's say the organic growth is 12% also, you'll get a 75-80% compound rate. Let's say give it a little bit of breath of fresh air, saying MSME market opens up, other we have dual listings happening in India and so on and so forth. You get to about 1.5 times, right? But it's still not 2x of where you are. Okay, you're at 1.5 times, you're at 6 trillion. Where does the remaining 2 trillion come from, or 2.5 trillion come from? And I think that comes from new offers, and that's why the IPO market is not going to slow down in India at all, right? And somewhere in that new offers, you're going to have new age models that are going to come, for which there's no corollary in the past, right? Zomato doesn't have any sort of precedent in the past, so Zomato can just get valued wherever it does. Policy Bazaar doesn't have a precedent in the past, so it can be at a 580 p, right, where the world is sitting at between 30 and 40 p, because it doesn't have a corollary in India, and India is a insurance star market. That market is going to grow. So if you think about all of these macro indicators, it's like someone has tied strings to the top of the puppet and is just pulling the puppet up. You have to get here. No, there's no option. You just have to get here. Now, sorry, I'll speak in Hindi for a minute. It's like Sam Dam Dand Bhed. Like whatever it takes is the English translation of that, right? Whatever it takes to get that, you are going to get there, right? And I think the people who don't just wait for luck to drag them up, but rather think about, the people, the product, the processes, the profit, those four levers that any business needs to basically hit it out of the ballpark. Do I have great people running my company? Am I selling a great product? Am I selling it at great economics? That means I'm always guaranteed a profit. And do I have the right processes so that every time I grow, I don't have to proportionally grow my costs. My costs are my revenue grows disproportionate to my cost, right? And if those four things are sorted, you're going to have companies that are going to grow faster, and you're going to have traditional companies that are going to go slower. And that compensatory, anything above the mean, is what I think the digital companies have an unfair advantage to grow. And that's the digital economy that we're investing in. So if you ask me, everyone talks about, oh, India this, or reverse brain drain. I'm like, everything is a derivative. Everything is a derivative. It's basically the most sexiest petri dish of opportunity that the world has left, right? After let's say, US and China. And the world is going to just come pouring into it, whether it's capital, whether it's people. I wouldn't be surprised. I mean, there was a time when there was literally like I forget his, Jonathan Bill, the gentleman who sold his company to Paytm, and Lizzie Chapman, the only two people Caucasians, I would say, like, lighter skinned, right, than us who were part of the founder ecosystem in India. My bet is in the next, by 2030, 2031, you're going to have more than 100 non-Indian founders, and I'm not just saying light skin. I'm saying people from all over the world who are going to say, forget everything. We're just going to go to India and build because we're excellent builders, and India is the land of opportunity because the macros will support us.
Right. Right. Yeah, that's a very interesting take. Awesome. So now let's talk about what are the sectors that are most exciting to you.
So I think my approach on sectors is a little bit like a process of elimination. So what I do is I first think about what I don't want to do right now. So anything Web3, crypto, um, this is where I use the word bubble very strongly. I don't see any macro application of it. I see people arguing, you know, to no end for it. At least in India, I don't see that we are that mature that we need a decentralized economy. I generally believe we need a centralized economy, which is everything needs to be pulled in one direction, right? So that's something we don't do. I think edtech is very, very bubbly right now. So again, don't want to do that right now. Never say never, but not right now. I definitely don't want to do businesses where there is a very strong brick and mortar need, or a very high debt need. And the reason for that is the minute debt comes in, equity becomes secondary. And so, you know, what happens is that as an investor, you want your returns in X number of years. But if you're always saddled with a certain amount of debt, you may actually miss a couple of exit cycles, and miss time. So any business which is very, very debt heavy, fleet operations, warehouse operations, REITs, are places where we don't invest, right? Um, Now I'll come back to REITs. It's very interesting for me, but I'll come back to that in a second. So we know what we don't want to do. Now, what we want to do is what we think India is going to be today, what we think will be attractive 3 years from today. So that 3 years from today is when the big checks are pouring in, the Series A, the Series B. So that 5 years from today, when I want to script an exit at Series C, Series D, um, is is really, so like, rather than trying to grab the sexy of today and then worry ki 2 to 3 years later someone is trying to claim me out of the cap table, do actually go down the long journey. Okay, so for me, I think three sectors make up 90% of my attention right now. So as I said, SaaS is very clear from BharatPe, built in India for the world, become a net exporter. So I will only, like, for me, it's very clear. If it's a SaaS company, it has to be a net exporter. So we are investing in things where the POCs are going on in India, and then we don't care about revenue and stuff like that. We do care, but we it's more about validation of the idea, and so something like user generated content. I think a big big way in India we can get that out, right? So I think for that is something that we are quite keen on closing, right? Then there is so SaaS is number one. Number two for us is definitely consumer, and consumer has split into two opportunities. One is the product opportunity, right? So the Mama Earths, the Forest Essentials, the Fab India example, those are large scale companies now, but they're early versions. So for me, there, I think it's only category creators. So are you coming in and creating a category? Because the Me Too segment is not an early stage investors game. So, like, for me, at least for me, I'm not talking about others. I'm sure others feel like, oh yeah, great guy. Problem is, five people have solved all the problems, and now we're going to come in and invest on this. For me, it's like I'd rather spend all my time evaluating that one company that actually solves. So, like, for example, we've invested in a company called Asaya, which solves for the brown skin, melanin rich skin, right? Skincare for the melanin rich skin, right? The founder goes to, the founder is the ex co founder of Paperboat, proven operator, goes to America, spending some time there. His wife has a dermatological situation. She goes, and they give her products which are made for Caucasians. She uses them, and they don't work. And then she goes somewhere, and someone gives her a product very similar to what a Latinx community or a Black community might use, right? And she says, "Oh, this is only 18 to 20% of the current population in this part of the world, but we're 98% of us are brown. Like, this is what we need to use. So why is this not like a billion-dollar company in India? Come back to India, launch that company." Now that for me is a category creator, right? Um, Another category creator for me is an example is a company called Dress Folk, right? They basically are building, are helping uh, your sort of Indian handloom and artisans and weavers break into the luxury segment, right? Saying you can actually, you don't need to sell only at Dilli Hard, you can actually sell D2C online to high paying people, and you can sell a sari for an average, 6 to 10,000 rupee sari, straight from the loom direct, and make all the money and actually be recognized for your art, right? So for me, those are what I call sort of category creator plays. And then there's sort of the, on the other side there are these, what I call the platform plays, for which I believe that that's aggregation, right? So can you aggregate? So a great example of that is a company called Apni Bus, right? Which is basically solving intercity travel on orphan routes in India. So Delhi Jaipur everyone solved for, but Jaipur Alwar much little, Alwar to a small town outside of Bikaner, maybe not at all, right? So how do you figure out those, and how inconvenient it is? So platforms. So for us, consumer is either category creators or consolidators. Then the last one for us is of course fintech, just because that's my first love, right? Can't forget it. And in fintech, like we're very clear, nothing consumer, no consumer lending, no consumer investing. Um, but when it comes to stuff like, um, you know, transformative SaaS plays within fintech, so underwriting SaaS, collection SaaS, wealth SaaS, definitely, something that people are transforming, or anything that is making the real estate uh, play in India more transparent. So there's a beautiful company we're investing in called Hecta, which solves the NPA liquidation problem for banks, allowing people to actually become like get uh, under sort of distressed assets at a discount, and use it as a wealth creation play. So I buy it today, next year I flip it for double, because it's a very clean asset, and I managed to buy it on the market. So just think of like a free market for startup for real estate investments, right? Great play, fantastic. So for me, those are some of the plays. MSME lending, huge play in India, right? How do you give loans to businesses? So I think fintech, consumer tech, SaaS sounds very cliche, but within that, if you go one level deeper, then you know exactly what we're investing in. For me, some of these things I think are the future in the next 3, 5, 7 years of India, and that's what I'm betting on. The last 10% is experiments. I think the age of food tech hasn't reached there yet, but we'll get there one day, right? Similarly, REITs. I was just mentioning REITs, right? Fractal ownership of real estate. Um, there's a beautiful company run by a bunch of young guys out of Bits called Prop Returns, right? Doing something fantastic in this space. So I think these are some of those experiments that you want to take, but they don't fit into one or the other sector. So you just take great bets. I give you a classic example. Vama. Vama is a bet that we took. It's a platform that helps digitize faith and spirituality, right? That's a bet we took from our fund. We're super proud of it.
Awesome. That's great perspective there. Thanks for sharing that. And let's now talk about, since you have been in the trenches,
Mhm.
seen that startup journey going from 0 to 10, 10 to 100 in different startups. What's your suggested approach for founders on how to get to early PMF?
So I think, um, in my opinion, early PMF has to be one problem or one use case very well thought out, which is, so start by saying, is my problem large enough? Is it critical enough? And does it allow me to make a significant margin in it? Most people play a margin business. Oh, that business runs, and when I enable it on tech, I'll make 2% of that, or I'll make 10% of that. But if you're already just taking out someone else's margin, then the problem in that industry is that the minute all businesses, when they mature, they undergo pricing pressure. If your earning is dependent on someone else's pricing, as the market even becomes larger, your opportunity is only going to get smaller. So if over a 5-year period someone's pricing becomes half, right? you need to grow 4 times to be twice as large as where you were earlier, right? And maybe the market doesn't support a 4x growth journey. So I think first, how large is the opportunity, right? What does a reasonable share look like? And at what economics can I get that? And within that, how much do I need to spend to be able to demand those economics? Second, what is my how much patient capital exists backing me? Do I have the kind of equity to raise patient capital? If I'm trying to solve a very large problem, do I have someone who give me money for 2 years and not push me what's happening? Can I figure that out? The so I think when a great problem arises and I have a great solution to that, I still need patient capital to be able to deliver that solution, right? And I think that matters a lot. So and more often than not, I see founders get distracted very fast. We're doing this, can we do this also? We're doing this. And I think what they need to do is you need to, like I often tell my, at least my portco founders, right? Um, one hero product sold on one hero channel, right? To at least one hero customer archetype. And that should be a third of your revenue, right? So 80% of your revenue should come from a hero product, which 80% of that should be sold on a hero um, you know channel, right? And
Right.
50% of that should be sold to a customer type. That means you've figured out that if I just churn this, so 80 times 80 is 64, 64 times 50% is 32. So a third of your revenue should come from selling a product via a channel to a customer. And that virtuous cycle should run. Now if that runs well enough, how do you then keep going and saying, okay, now can I make a 5% or a 10% incremental change, or can I come up with a premium plus or a light plus version of this product, and then sell this product to my customer segment plus plus or my customer segment minus minus, and bring that a third to 50% or 60, 70%. And that's when I reach operational break even. So now I know that when I'm selling my core product, I'm not always burning money, and then keep layering on top of that other things. I think people start trying to do cross sells or diversifications or pivots too fast, and that's when I think problems really become. What an investor wants to see is, they don't want to say, look, you give me money, I'll grow like this. What they want to see is, I'm growing like this. If I got your money, this growth is going to go like this. I could go slightly faster. I could turn my curve a little higher. I'm going to go like this. I could go like this if you put the money. So just this inflection, this I'm already done. The problem is people come at a flat and then they say, give me money and I'll grow. And I think that's the worst thing that I've seen.
Right, totally makes perfect sense. And to the last main question, what's been your biggest learning investing in startups over the years?
So for us, I think the biggest learning for me in startups has been is, just because it's your money into the company, it's not your company and it's not your problem to solve. So I think being an operator, that was the hardest lesson I had to learn, was sometimes you need to, like, you need to make your capital patient, and you need to be patient. What's happening? Why isn't it growing? When does it grow? When does my name come in the papers? When do I show the 3x 4x? I have this very dear friend of mine, like amazing person, called Nikhil Bhandarkar. He has one of the best portfolios in the world today, at least in my world, my ecosystem, early stage ecosystem. And I'd never hear him say, I've never heard a founder say, oh my God, Nikhil's pushing me to grow or do this or that. And then for many years, he just kept doing. He's one of the guys who made me into the VC I am today, right? And somewhere along the journey, now every month there's like, he's saying, oh, very happy to announce portfolio company X has raised Y dollars. And then the next month is A has raised B dollars. And I'm like, dude, like, it's just the most classical example of being a founder's best friend and empowering them with patient capital. And the only way of, in my learning, the corollary to this is, you will always have patient capital when you don't have anxiety, and you'll always have anxiety when you have deeper conviction on the bets you take. So do whatever it takes to build that conviction, right? In my case, it's like I build an AOP with my founders. I try and keep some North Star metrics. We have like quarterly glide paths. As long as they touch it, I tell them, look, this is not for you. This is for my anxiety. If I know you're hitting these glide paths, my anxiety is low. My anxiety is low. This capital is patient capital. Otherwise, I'm egging you and saying, why aren't you raising another round? Why aren't you going out there? What's the valuation? What's the metric? So for me, those things matter a lot. But yeah, my learning has been, you know, become a provider of patient capital, whatever it takes, how you get there. You'll see transformative returns.
Absolutely. And that's a very interesting approach you mentioned. So you're communicating your expectations at what stage a company
Yeah,
should reach what stage. That's very clear from the outset, right?
yeah,
Awesome. That's a great approach. Now to the rapid fire round. I'll ask you
please,
6 quick questions
sure.
about the investing you're doing. So the first one is what are the sectors and regions you invest in?
So we invest a lot into. We're only in India. We're a for Bharat from Bharat fund, and we invest into predominantly into fintech companies, consumer tech, consumer durable, and FMCG, and SaaS companies. Those are our four core focus areas.
Awesome. What's the typical stage of investment?
We invest either post your angel round, so we don't do anything pre-seed. We do seed or seed plus or pre-series A, whatever the term you want to use. But a beautiful way to put it in is uh, we invest between 5 million to 12 million, or what's called a 40 crore to 100 crore post money valuation. That's sort of our sweet spot where we come in.
Right. Do you lead rounds?
Very rarely. We usually co-lead or co-invest. We need someone who sort of has a deeper conviction than us in the form of the size of their check for us to invest.
Right. What's the typical check size you put in?
Our first check is anywhere between 1.5 to 3 crores, and our follow-on check is usually up to $1 million.
Got it. Where can founders get in touch in case there is a direct way?
So we have a link on our website. We give a response within 48 hours. We also have, LinkedIn is a great way to get in touch with me personally. I respond to everyone within a day of getting a LinkedIn message. I actually clear my box at night. Or you can write to me at dhruv@eternalcapital.vc.
Awesome. I'll make sure to put all that in the show notes below. Last
Yeah.
one, where can our listeners follow you? I think that'd be LinkedIn. Yep.
Yeah, so LinkedIn is a great one. I usually just stay on LinkedIn a lot more.
Hmm.
I'm not a very big social media guy. I've been told I need to improve that about myself. But we're doing something cool at Eternal very soon on the content space. So hopefully the Eternal in December, or actually in January, you can follow us on our YouTube page, and we're gonna have something really cool coming up. And maybe we'll have Prashant back as a guest then.
Thank you. Thank you so much for your time, Dhruv.
Thanks.
I know you're running late.
Thank you.
Thanks for coming on. I love your insights and the way you're investing. I wish you all the best.
Thanks, buddy. Thank you so much.